Golly, holy smokes, folks, another terrible miss. It's not just the CPI number that came out this morning, but oh my gosh, folks, it is 7 a.m. Literally just got the University of Michigan consumer sentiment print and inflation expectations, and this full-on sucks balonies. Like, I should not have put this on today, okay? I jinxed it to the moon. I jinxed it. Or it's because I'm literally packing right now because I'm going to Canada. Every freaking time I leave goddamn town, this shit happens. University of Michigan consumer sentiment. Last survey was 58.4. The current expectation was that we were going to get a read of 58.1. What did we get? 50.2. Absolutely terrible miss. Under 50 is like very bad. That means more people are upset than they are happy. And we're at 50.2. We're almost there. University of Michigan current conditions. The expectation was 62.9, slightly down from the 63.3 before that. Comes in at 55.4. Disaster. 1 year inflation expectations. This is a bad one, okay? This 1 year inflation expectations, we were at 5.3. Then we were expecting to remain stable at 5.3, comes in at 5.4. That means inflation expectations have gone up for the 1 year inflation. For the 5 to 10 year horizon of inflation, we were at 3%. Now we're at 3.3%. Also rising inflation expectations. And regarding consumers' expectations for the market, prior release 55.2. Survey, 55.3, as if things got better all of a sudden. But no, it comes in at 46.8. I mean, horrible miss. As the numbers came in, I said to my dad, if those inflation expectations go up, stocks will go down. And sure enough, that's exactly what happened, because the sentiment came out here, and then boop, 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 boop. Okay, but this is beside the point, because I gotta show you what's happening with this particular chart that I gotta show you, because it's another freaking disaster. Okay, so I'm gonna pull up these charts, but I want to quickly look at the 5-year break-evens. 5-year break-evens. This is the market's expectation for inflations, right? For future inflation. Peaked today at 3.16. Like we had a nice big run over in March and April. Here, you know what? We'll just put up a screenshot. We had a big run in March and April, and then I kind of plummeted. It's like, okay, all right, you know, the peak is behind us. Like peak inflation is here. We're good now. Everything's good now, right? Yeah, not even close. And so what's happening? Inflation break-even expectations for the market are rising. That's that part right here above my head. So you can see we're down from about that 3.8, but look at the spike that we're getting over here. And it totally makes sense with what we're seeing, not only with the huge miss on inflation this morning, but also the consumer estimates that we got, which, you know what's really ugly about the consumer estimates that we got this morning with inflation expectations rising? That survey was done before this latest inflation print came out. So if consumers are like, oh my gosh, we have the worst inflation in 40 years, but at least maybe it's peaked, and their expectations for inflation are going up, and then all of a sudden we get an even worse CPI print, well then consumer expectations for inflation would rationally go up even more. So in other words, this latest consumer estimate or expectation survey doesn't even consider the impact of like Tucker Carlson now telling us about the absolute worst inflation. On top of this, you got the 10-year treasury jumping to 3.17. Folks, that means mortgage rates are going to tick up again. And not only are they going to tick up again, but what else? Well, real estate prices probably going to get a little boopsie doopsies. And that's going to create some opportunities. And that's why a lot of you are signing up for the programs on Real Estate Wealth link down below. Whether it's the bundle, most of you going for that bundle for the 0 to millionaire real estate investing, and then the do-it-yourself property management or rental renovations so you can run a lean ship and save thousands of dollars on your renovations and join our Lowe's partnership as well. Check it out via the link down below. But I got to show you these charts because these charts signal a bigger problem right here. You ready for this? Right here. Look at this. This was the CPI month over month chart. Remember we did this yesterday on the whiteboard? It looked like this. This is a zoomed in picture of my whiteboard, right? That's what the chart looked like. Well, that was just me kind of hand drawing it. This is what it looks like in the back end. And what I want you to see is that this bell curve right here is where the estimates are, right? So here you have economists betting here, here, and here. And it's, how many economists you have betting in each place. It goes up in increments of 5 over here. So you've got, dozens of economists. Well, look at this, folks. This is where everybody was. This is where inflation came in on the month over month. Let's try the experiment again. Oh, core CPI. This is where everyone was. This is where it came in. Let's try year over year. This is where everyone was. This is where it came in. What does that tell you? It tells you that we need to get Paul frickin' Volcker on the phone because our economists, the people who are supposed to be brilliant, all these people, the people who are supposed to be smart and brilliant and know what they're doing, and the smart money people and the researchers over at the Fed, they're the ones who are supposed to be telling us what the hell's going on, and they consistently get it wrong. It's devastating. So how could you rely on this? And so now this increases not only the odds of getting a multiple 50 basis point hikes, but it also increases the odds of potentially a rug pull Paul Volcker move where all of a sudden we just get some kind of big hike, like out of the blue, like an intermeeting hike of 100 basis points or something like that. Could you imagine if this afternoon Jerome Powell comes out and goes, folks, emergency meeting, forget next week's meeting, we're going to raise rates 1% right now. That's 100 basis points right now. What do you think would happen to the stock market? Okay. Now, what we also should do is, look at the expectations right here for the rates at the end of the year. So last week, the market was expecting this top line right here, that we would be somewhere between 2.5% to 2.7% by the end of the year with a 36% probability. Well, that's now moved down to just 8%. And instead, what's now a 37% probability is actually a whole nother 50 basis points higher, sitting, right here at 37.3% chance of being at 3 to 3.25. And the dot plot that we get from the Federal Reserve next week wouldn't surprise me if at the end of the year it says something like 3%. And that's probably going to lead the market to sell down as well. I mean, it's just bad. Tesla's down 3.5%. The NASDAQ's down 3.22. We're still off the bottom on the NASDAQ. But if we end up getting any kind of Volcker action here and we keep getting these sorts of reports, we are not leaving this floor. And it sucks big time balonies. That's what I have to say. It sucks big time balonies. And I'm sticking to it. Not only am I sticking to it, but now I'm going to go. I'm going to go hop on a plane and I'm going to get the heck out of here. I'm going to Canada. But if you want to learn about real estate and save lots of money and get ready to go make lots of money, check out that link down below and I'll see you in there. I review every deal that people put into escrow, and I can't wait till the end of the year, maybe mid next year, beginning to mid next year, when we go shopping for deals and I look at all your deals. Even those of you who are buying now, I look at your deals. Zero to Millionaire Real Estate Investing Program, link down below. I'll also look at your remodels in the Do-It-Yourself Property Management and Rental Renovations course, or help you with your tenant questions in our course member live streams. Thanks so much for being here. We'll see you in the next one. Goodbye.